Good morning, everyone, and welcome. Thank you for having us. Thank you, Mandy, for being with us today. Over the course of the next 30 minutes, we're going to be exploring some of the forces that are shaping global banking, from economic uncertainty to geopolitics to the evolution of digital assets and the financial infrastructure. Mandy, we'd like to start with geopolitics. There's a lot of talk right now around the war in Iran and discussions of global fragmentation. It would be great to understand from your perspective how you're helping clients kind of work through these issues and manage geopolitical risk and, just the volatility of the market.
So thanks, Jess, and it's a pleasure to be here. In fact, I found it very instructive to listen to Todd and talk about the priorities for BAFT. I think, very much in keeping with the question you just asked, where clearly geopolitics is top of mind, I think, for everyone, as well as some of the other things we'll talk about in the sort of regulatory space. So really a pleasure to be here today. So I think to your question, what we see is the global order really kind of undergoing a fundamental transformation, sort of moving away from this, what we saw previously, which was kind of a predictable rules-based system, right. And kind of where countries would default to kind of long-standing alliances and agreements that they had made with each other over time, towards something that is much more transactional and multi-aligned. This trend actually started before the Middle East conflict, with the U.S.'s new tariff and trade policy that they announced on April 2nd of last year. And again, just going back to Todd's opening remarks, he mentioned this BAFT tariff roundtable. As you know, we have a daily roundtable ourselves at Standard Chartered, and given what's been going on, it's persisted all the way through, this Middle East conflict, and is acutely relevant every day for us as well. So, at the beginning of this year, even before the war started, Standard Chartered surveyed nearly 400 of our clients across China, kind of Southeast Asia, and the Middle East. And, we sort of asked them what they thought would be the most significant drivers of change in 2026. And a whopping 63% of those surveyed said geopolitical tensions and trade restrictions would be, the most significant driver of change. That's before the Middle East conflict. And the next highest result was new technology, which is AI, at only 21%, which I thought was remarkable given how much talk there has been about AI and AI deployment. And then when we asked about the most impactful consequences of that change, our clients felt that the number one impact would be shifts in trade routes and supply chains. So rather than government response, rather than policy changes, it was really down to this, sort of supply chains and kind of trade routes. And of course, as we see now, our clients were right. Okay. Yeah. So, countries kind of at the national level, countries are really reassessing and rewiring their connectivity, security, trade routes, technological dependencies, kind of really making international relations a lot more transactional. And, the war in Iran and the associated disruption to energy supply is really just accelerating all of that.
Right.
So, we also see countries asserting power through, what I would see as an expanded set of sectors. Okay. So now it's finance and energy, technology, and even real estate that, we're seeing nations treat as essentially matters of national security, right? And so an example of this dynamic is how the Strait of Hormuz is being leveraged as a strategic choke point in this negotiation between Iran and the United States. The closure of the strait, as we all know, is having a massive impact on oil and energy prices, which is starting to have a direct impact on businesses, sectors and countries globally. And these dynamics are really the backdrop for what our clients are seeing and reacting to. So when you think about companies, the conflict has obviously significantly disrupted supply chains, leading to higher fuel prices, uncertainty around energy supply, logistical bottlenecks, and rising operating costs. And I think all have seen some very tangible examples of this. Obviously, airlines being very prominent,
Yes.
canceling large parts of their schedules. We've seen, unfortunately, here perhaps the first casualty in Spirit Airlines, where an already precarious financial situation was exacerbated by fuel shock or fuel price shock. Many nations are also seeing just gas prices surge, and we see this really, not even just here, but in Europe in particular. And then other nations around Asia having issues with supply shortage, of all sorts of petrol products. So, against that backdrop, our clients are focused on diversification. I think when they look at supply chains, they're thinking not so much about cost efficiency as they used to, but more around security. So how do I make sure that my supply chain is reliable and resilient? So that's causing them to reassess strategically energy sourcing and supply chain configuration. And so for us, what's interesting about that, given our footprint, is we see two things. We see clients moving towards what we call kind of a local for local approach, where they can minimize supply chain disruption by containing it within a kind of more local area. And we saw that first in ASEAN, and we continue to see that throughout the markets that we operate in. And then we also see significant growth in South-South trade. So that is really expansion into new corridors, again, between ASEAN, Latin America, Middle East, and Africa. And both that's for supply chain and also, end market goods delivery. So for our clients, we see all of them thinking about how to navigate new relationships, new corridors, new geographies, and we're really engaging with them and how to leverage our network to help them to achieve that.
So if we look beyond the war, what do you see as like the real potential, building on what you just said, in Asia, Africa, and the Gulf in general?
So I think, first we have to think about, what dynamics the war has created will actually persist post-crisis. And I think first I would say this trend towards multi-alignment that we just talked about, and the resulting push to diversify supply chains, and changes in relationships that result from that, we think that's permanent. That will remain. And also the trend towards local for local and sort of South-South trade, again, we see that as a more permanent shift. In relation to specific countries or regions, obviously, we need to think about the Gulf first. Yeah. So GCC, we have a strong local presence in the Middle East. We're on the ground there with physical premises in 10 countries across the region. And throughout this conflict, we've been on the ground, present there, speaking to governments and obviously also our clients. And the Gulf countries, may have some residual economic scarring from this war. They've suffered infrastructure damage, as we all know, that will have to be repaired. And already the Saudi government, for example, has said that they're going to redeploy and change their spending priorities as a result of the conflict. We know that quite a bit of investment will be required, from governments. And now we've also seen the UAE say they're pulling out of OPEC, which we think is a sign that they're just prioritizing their own economic interests above all, given what's been going on.
Right.
On top of that, Gulf countries are really considering what comes next. So prior to the conflict, as we all know, the Gulf was established and known for being a safe place for international business. Governments around the region will be focused on ensuring that remains the case. Mm-hmm. For Africa and Asia, in the short term, they contain the markets that are probably the most vulnerable to shortages that are being created by the closure of the Strait. So Asia has the highest dependency on the Strait products in terms of energy and also fertilizer for agriculture. And parts of Africa, mainly East Africa, also rely on the Middle East for energy supplies through the Strait as well. And so, and you have to think, emerging market economies in Asia and Africa don't have the same resilience as larger economies like the United States to withstand energy price hikes and shortages for a long period of time. But when you think about after the conflict, these are the fastest growing regions in the world, right?
Yeah.
And so you think sort of Africa and Asia, they have the youngest and fastest growing populations on Earth. Africa is increasingly strategic for, its natural resources, critical minerals, which has been, a huge focus for everybody here. And we've also seen this big trend of the rise of the middle class across Southeast Asia and ASEAN countries. So, and I'd also, to add to that, I'd like to throw in Latin America. So the dynamics around Latin America have really changed with the Trump administration coming in and their new foreign policy. We see really big focus from the US government on Latin America and in particular on investment. Venezuela is a great example of that, where, there's been a specific call for American business to invest. So this is why we think there's a lot to play for in the global South in the longer term as a result of these new geopolitical dynamics.
Thank you. That was great insight. Yeah, I want to shift a little bit now to digital assets. So I know since you joined the firm, this has been a focal point for you, a big theme in the market. How do you see digital assets kind of shaping cross-border in the future?
Yeah, so you're right. Digital assets is a really important topic, and we believe that digital assets are emerging as really a cornerstone in the next era of banking. We just think it's inevitable that money will become digital. It's logical. It makes sense. As a non-US bank, Standard Chartered has been developing capabilities in digital assets for 10 years, including in trading, custody, and in supporting digital currencies like stablecoins. And we now have these capabilities live in our markets in Europe, the Middle East, and Asia. So for stablecoins specifically, we see tremendous potential. Our research expects stablecoin market cap to reach approximately $2 trillion by the end of 2028.
Wow.
Yeah, and if you think about that, we project that could result in approximately $1 trillion of fresh T-bill demand as reserves backing the stablecoins. So it's obviously a huge opportunity. And it's interesting because when I speak to people in the US about this, which I do quite a bit, they often say, really, kind of what's the use case for why would I use a stable coin?
Right.
And I think from our vantage point, we see real utility for stablecoins in cross-border payments, and particularly in emerging markets. So as I don't need to tell the people in this room that international payments can be a pretty clunky process.
Yes.
With a lot of legacy systems dictating several steps that are needed to complete one payment. And in many emerging markets, they don't even have, they don't even have the rails to kind of receive payments cross-border, which means they don't have access to cross-border funds. Right. And so stable coins allow us to leapfrog those legacy systems and just jump to build access to funds in those countries digitally, so that money can literally flow everywhere. We also see kind of clients focused when you think about maybe more of a use case that would speak to people here. We see clients here even focused on operational efficiencies within their structures, that comes from using digital technology to transfer money or transfer securities on a tokenized basis. We know corporate treasurers are quite focused on those developments. Yeah. And then finally, everyone's favorite topic, AI. All of that sort of, you sort of think about AI, it gives an added dimension to the idea of a digital currency, because frankly, all of us, will, if you're not already experimenting with AI agents, either for yourselves or in the workplace, eventually it'll come. And one of the efficiencies in deploying an agent to operate, on a human's behalf is in transactions or commerce. And for an AI agent to engage in commerce, they need a programmable currency in order to do that. And so we see a big use case for stablecoins in that as well.
So building on that, how do you see both blockchain as a technology and a product, whether it's through digital crypto assets or, a tokenized deposit?
So, blockchain is interesting because, we don't think about it just as a crypto
Right.
technology. We think of it actually as a market infrastructure upgrade. So today's system for payments and settlements works, but it's clunky and siloed, as we've said. Trading, clearing, settlement, and custody, they all have separate legacy processes with time delays and capital trapped in between. So tokenization and digitization, when you think about it, it compresses and upgrades that. So, you move from what would be sequential processes to, atomic programmable transactions where assets and cash can kind of move together. And, that would have an immediate impact on timing. So you have, liquidity, collateral, and counterparty risk. They're kind of vastly changed as a result of that. Yeah. I think one question that, we can talk about is, what happens to banks with, with blockchain technology.
Yep.
I think a lot of people believe that blockchain technology means that everything can just happen automatically and simultaneously. And so, right, you don't need intermediaries. Right. I think for us, it's an important question, but we think that banks still have real relevance in
Absolutely.
That future state. Yeah. Because obviously banks are the police of the financial system today. We think that regulators would continue to rely on us that way going forward. Mm-hmm. And actually, banks also have a big role to play in policing or handling operational risk. Right. And I'm sure that's something that you see quite a bit as well.
Absolutely.
Yeah.
And you mentioned regulation moves on to a great topic. What are your thoughts? We're hearing a lot about, simplifying regulation in the US. What are your views on this new regulatory agenda?
So regulatory simplification is a really important agenda for us. We are hugely in favor of it, yep. as I'm sure everybody in this room will agree with as well. And so regulatory complexity for banks has been a huge theme for some time, especially as our businesses interact with multiple regulatory regimes around the world. We're a global bank, as you know, it's Standard Chartered. We're regulated in 54 markets around the world. And, we have to observe regulatory requirements in many more. Yep. Okay, so it isn't just about, where are we subject to regulation? Where do we have to report? It's actually also just, if you think about all of the different markets that we have to operate in, kind of creating, a way of seamlessly interacting against that backdrop is pretty complex. And so, complexity in that is created by regulatory fragmentation or divergence is a huge theme for us. We think that divergence in regulatory approach creates a lot of friction in the global system, makes it a lot harder for institutions to operate across borders. And so we've advocated for convergence where possible with authorities in the US, the UK, Europe, and around the world. With the US regulatory simplification agenda, we seem to be entering a new phase of bank regulation here in the US. After the 2008 crisis, the focus was on strengthening banks' resilience, higher capital, stronger liquidity rules, more intensive supervision, and detailed resolution planning. But the discussion is now shifting to how did those frameworks actually work, right? And how do they work in practice? Right. Fed Vice Chair Bowman has noted the growing complexity for banks in terms of complying with all of these different regulatory requirements, across all of these different spaces. And of course, she's focused on supervision. And we now see the Fed modifying their approach to supervision with a new focus on core fundamentals of financial risk, which, from my perspective, is very, very welcome. However, we still face quite a lot of complexity,
Right.
especially when regulators around the world address the same issues differently. As an example, and I think this is something that, again, Todd referred to in his opening remarks, between the US and Europe alone, when you look at Basel III Endgame, there are widely divergent approaches to quite specific elements there, including stress testing or GSIB capital surcharge. And those things will have a direct impact on global banks, depending on where they're headquartered. And that is incredibly important from our perspective because, ultimately, if that remains the case, inevitably there'll be some regulatory arbitrage in the market.
Sure, right.
It'll impact, capital flows, and, in ways that, we think fundamentally are unhelpful. And we believe that regulators would view it that way as well. One of the reasons why we have what some people refer to as quote unquote shadow banking or the rise of private capital post 2008 crisis, which by the way, I think a lot of people view as a positive development. Mm-hmm. I think regulators, have commented that has been a sort of perhaps a greater outcome than anticipated. You could have a quite similar outcome from this as well, if the divergent approach remains the same. So, we're watching that very carefully. We're watching the regulatory landscape in Europe overall, because not only in this space, but also more generally in Europe, policymakers are increasingly focused on financial sector competitiveness. EU commissioners have mentioned that as a critical focus for them. And I think the move in the US towards perhaps a more commercial approach in the Basel III space, but also just more generally in terms of reg simplification, I think that has highlighted the importance of that competitiveness agenda. The EU has acknowledged that their framework on their own has become complex as well, and is exploring ways to try and streamline reporting and bank supervision. However, although that is well articulated, the proof is in the pudding, as it were, right? It's in the behavior. And so, although those articulated objectives between the US and say the EU are converging, the real test will be, how they're implemented, which is yet to be seen. And I would say also regulatory fragmentation is also important in the digital asset context
Absolutely.
as well.
Yeah.
So, one of the things that, when people say, okay, going back to the stablecoin discussion, it sounds great. Currencies and securities will need to become digital over time. If you accept that, it's kind of like, okay, well, what's holding us back, right? What's holding us back from that? And similar to this space, regulatory fragmentation is a big part of what is stopping us from having, kind of already reached a unified approach in the digital asset space already. The thing that we need in order to create a digital currency that will really flow across borders in the same way that money does today, you really need interoperability. And the only way to incentivize that kind of interoperability is through some sort of convergence of regulation or regulatory approach across borders. And I think we are very, very far from that. We have different governments taking different views on their preferences in the architecture of digital currencies. Obviously in the US, very big on stablecoins. Other countries are much more comfortable with CBDC, central bank digital currency. And even just apart from that fundamental divide, you also have a lot of questions around how these instruments should operate moving across borders. And until some of that is resolved and people come together and really, prioritize, a convergent approach, it will be difficult to incentivize even the private sector to come up with one interoperable method. And I think that is critical and something that we speak a lot to regulators and governments about.
But overall optimistic from a regulatory standpoint.
Absolutely. Well, I think the direction of travel in the U.S. makes me optimistic.
Yes,
And I think, has a lot of wins for banks and financial institutions. And I think in general, for us, kind of going back to the original geopolitics theme, it's interesting because obviously periods of change and uncertainty create a lot of worry and nervousness in people in general. But I think this push towards multi-alignment makes us very optimistic about opportunities. Yeah. And I think that plus renewed commitment from governments like the U.S. in investment in emerging markets, in our case, I just mentioned Latin America, but you also see this kind of similar commitment all around the world to that. And I think this push towards diversification really means that you could see the global trade landscape reshape itself in a new way, and it's sort of a re-globalization, which I think makes us very optimistic about opportunities, kind of in the years to come.
Yeah. Well, Mandy, thank you so much. This was so insightful. Really appreciate it. And yeah.
Thank you very much. Thanks a lot. Everyone. It's been a pleasure to be here. Thank you.
Thank you, guys.